So the way we looked at it is, to start with, yes, it's a genuine problem, but it's all about how you can, so the fraudsters are smart, they are adopting new technologies, they are putting them into play, but what is very critical is, we as potential preventers of fraud, how do we outsmart them? That is the entire game which we thought. And especially, just introducing myself, I'm Arpan from DronaPay. We are a platform which does real-time fraud prevention for fraud and AML both. In fact, we were part of the first cohort, so it's great to be back here seeing a lot of known faces. And I was telling them that if these guys didn't exist, our business will stop. If there are no fraudsters, what do I sell as DronaPay? So they are also contributing to my business. And I think two people who do better selling than we ourselves is, one, the fraudsters, two is the regulators. Because the regulators are building in the guidelines which are prompting people to act. Because otherwise, as you know, banks are very happy, they don't want to rock the boat, too much of investment involved. Now coming specifically to the topic around this deepfake and eKYC, the way we are seeing it happening is, you have to look at it from an entire end-to-end cycle. Whereas the eKYC frauds are happening on the initiation part, which we term as more on the onboarding side of the journey, a lot of it is happening on the transaction monitoring piece once the transaction has been initiated. And recently RBI gave a direction on that. Earlier, the checks on the AML side were required to be on the eKYC and onboarding side only. Transaction monitoring was not happening, which was primarily run out of certain Excel sheets and submitted to the FIU through an STR. Now there's a mandate that you need to do transaction monitoring for AML also. The reason being, because of this AI piece coming in, there's a constant evolution happening in the way fraudsters are trying to defraud yourself. So unless you make your journey an ongoing one, rather than an initial check on the eKYC part of it, then you won't be able to protect yourself. The other aspect, thanks, like we had a banker, we had an academician, we had a startup founder, so we got all perspectives. From the banker, we also realized, and I found it very interesting, that even today, it's not, there are two pieces to it. One is, possibly some people never knew that deepfake will become a problem or something like this will come up. So it's something that you learn as you evolve, be it on the institution side or the product vendor side. The second is, even if you're aware of certain pieces, you don't act on it till the regulator gives a danda, which is a fact of life. So what we need to constantly do also is, from a evolution perspective, you need to correlate various things. It can't be done, a decision making or prevention of fraud, which is resulting out of a AI ML driven fraud engine. You can't do it in an isolated fashion. I'll give you a very simple example. Say somebody is faking to be you and has managed to get access to your mobile banking or internet banking username and password. Ideally, if I have your username and password, I should be able to log in and transfer money and take money out of your account. Today, what we are trying to do is, you need to correlate the various aspects such that even if I have your username and password, I may not be keying in the parameters or the password the way you key in, the speed at which I type. I might not be doing it from a device which typically is attached to your profile. So those are the kind of alternate data sets like IP, geolocation, etc., which are also becoming very critical to correlate when you're trying to prevent this evolution which is happening in the fraud space.
I'm a die-hard Harry Potter fan, and I want to quote Albus Dumbledore here. He once said that happiness can be found in darkest of situations if only when one remembers to switch on the light. And I think open banking is the light for us. So a lot has been said that customers should behave, customers should be disciplined. At the end of the day, the data resides with these big institutions, and it is upon us how we can make these innovative solutions and provide to the customer. There's no point sitting on a pile of data if we cannot make that credit enablement we keep on saying that there is a funding gap between MSMEs, there is a gap on the rural side of it. But what have we done as an institution or as a regulator? Because regulator just says that be cautious, be vigilant. They have laid the foundation for us, but it is upon the banks and several institutions to enable this and make it available to the people in general. While I know that data, as the previous table said, that the data is the new oil, what has been said, but people are making some misuse of it. So as a bank, we are guided by RBI's regulations of data privacy and whatnot. So it is important to be, safeguard the customer data, but let's not be so conservative that we end up not providing the right solution to it, innovative solutions to it. And fintechs are doing a fantabulous job of onboarding the customers. So I like to coin a new term called DAS, so distribution as a service. So banks these days should play as a role of distribution as a service, whereas fintechs and domain techs should play as an onboarding partner. And when these two partners come together, shake hands and work cohesively, I'm sure new innovative solutions can be provided in any manner, and it will definitely reduce the funding gap. So I think that's the key takeaway of open banking.
So the topic here was about the role that influencers are playing in investor awareness. How is SEBI's recent control on influencers narrative going to affect financial literacy? What should the firms that have been tying up with influencers to create awareness should do going forward? And what are the ways in which SEBI today can manage the effectiveness of financial literacy through these people and also continue to protect the customers, right? So these are the 4 questions that were supposed to be discussed, and fortunately we were able to touch base upon all the 4. While we all 5 were appreciative of the fact that financial influencers have been doing a great job of making sure that people are aware about a lot of financial options that are available, the only problem that we faced, or we thought, was the moment they crossed the line and started suggesting solutions which they were not supposed to do. That is where the problem really started happening, and that is where SEBI came in. So the solutions that we thought was, in which the SEBI can start controlling them was, by making sure that they are licensed to give proper financial advice, making sure that there are proper disclosures, disclaimers, there are warnings, and also from a legal person here, there was a suggestion that they should be coming under CPA, which is Consumer Protection Act, and also making sure that it is not just the influencer who is controlled, but also the people who are going to use these influencers. For example, there was Wald that used, and that created a big issue for all the followers of many influencers that suggested Wald. Can we also not control Wald? Not just controlling the financial influencer, but also making sure that the guys who are partnering with these financial influencers are also controlled.
So what are we looking at is this COP 26, 27, that's all happening while we are copying out from taking those responsibilities at the national level or international level. So 2 points for us to make is, one, we recommend a cohesive policy at the international level where carbon credits can be really valued and traded, right? That's one recommendation that we have. That's at the policy level. So we don't have much control, but this is something that the market needs, and that will open up or unlock a lot of capital and a lot of play area there, right, for various fintechs to come in. Now, in terms of the recent change in the policy that the government has announced in terms of the solar for the country, so we wanted to double down and see what we can do there. And this is the idea that we all came out with and we all agreed on, is that solar, as it goes, the challenge is that there are multiple parties that get involved. There's someone who's integrating that, there's someone who's financing, but the financier finds a challenge when he's financing a 10, 15, 20 year kind of project, and the asset is installed in somebody else's place, right? So he doesn't have a recourse. So there's a contractual challenge that he faces where if the incumbent is not paying, then what does he do with that? So instead, what we are flipping the coin and we are saying that the idea could be that you can make, let's say you think of a society where multiple flats are there, hundreds or thousands of flats are there. Community-based solar investing can happen, and there could be platform that can enable that. Each individual resident can actually contribute. That becomes an alternate financing method or P2P financing equivalent there. We also found a company already trying that in the name of Sunday Grids. So we see there's multiple places there. You can build that similar activity for not just a society, but even for a RWA, even for a single area or a pin code. You can extend that to multiple other areas as well. Even in a corporate working, right? So you could say that, can my CSR fund that goes into these green activities, can there be credits availed against that? And or can the policymakers put in some number there to ensure that a certain under the 2% CSR fund, can a subset be created for this? This is one aspect that we, again, in the policy domain. And then the last one is, sorry. Yeah, and in terms of the consumer behavior, right? So what we also are recommending, or there's a product potential there, is for all the credit cards that are out there, can we create a new green corporate credit card where it becomes a pride factor and also it becomes a certain utility for people, where your MDR rates can be preferential if you are holding a green credit card. So there's a fintech play that's out there which can actually get a lot of climate or impact VCs attracted to that. Essentially, you are reducing the MDR for these credit cards, or you are subsidizing the MDR there, right? So because you are doing those essential aspects, and the credit card will actually give you those measurements on your spends, where you are actually using it for a really reduction of your carbon footprint.
So we had a very healthy discussion. We did not have enough time to cover this. So we basically went into what can be done straight up. And I would like to sort of divide all of our insights into founders, regulation, investors, and best practices. So founders, one of the things that we talked about was the fact that a lot of founders are not aware of internal and external sort of governance practices. So how do you bring that awareness in? You also had an interesting discussion about how the ethics of founders kind of matters, right? A story that came up was how an investor said they would not fund a company unless he visited their home to figure out how they dealt with all the little things and other things in life, right? So, so you essentially were looking at, there was a sort of recommendation for psychometric tests to be done of founders, sort of inner and outer scorecard, and also what is the internal anchor for the founder, right? And so in order to kind of figure out what their ethical sort of compass or moral compass was. You also looked at investors and saying that investors should not dismiss ethical and governance practices by saying that, hey, startups will be startups, sort of like akin to boys will be boys sort of a thing. Make sure that there is zero tolerance, make sure that investment is aligned to governance, and also money for compliance, because compliance is also expensive, and that kind of feeds into how startups might not put them at top priority. We need to grow, we need to innovate. So how do we sort of bring in sort of money for compliance in investment as well? And also investors could be held accountable at some point in terms of saying that you can't have sort of observer seats in the boards by saying, we put in the money, we take out the money, but we don't have skin in the game. So how do you sort of bring regulation? So that kind of brings me to regulation aspect. Also the fact that governance for unlisted securities, you should have sort of 6-month reporting mechanisms at least that kind of come up. And the last bit was about best practices. So a few of the best practices we discussed was transparency among all stakeholders from the get-go. Important that the companies, startups should have a CFO, have quarterly board meetings, the agenda sent 15 days prior, meeting minutes are shared. And so essentially all the stakeholders are on board.
That as a core, we said startups would not be any different because they're usually governed by people who have invested money, and money is something which, the tail wags the dog, and investors will tell you we want this, or they say we want that, we want returns, and people will start changing, modifying their behavior to deliver the results which are usually money-oriented and something measurable. Ethics is not measurable according to us, so it's not. It's something which has to be in you and it is available. But what happens is, it starts off from when we had Sandeep, and he says we need to recruit the right kind of people. We need to have mentors. We need to have, yes, it's nice to say investors, it's good to ask, but no, they must ask. It also means when you're a startup, it's very nice to ask for money. And unfortunately, that might be the easiest part compared to what comes in future. And we have cases in life which happen where they are caught because of bad governance or bad ethical decisions which they have made. That means you should start having somebody on the board in your core group which are taking this as their only job responsibility, making sure ethics is important, the kind of culture you build for the future. Of course, we decided there could be two kinds of companies, a startup which flips after 5 years, sells it at double and then goes to the next startup. That's one kind of startup. But if you want to be a startup which is going to invest in the long term and become an organization which is going to stand the test of time, then you need to make sure you invest in people from the ground floor up on ethics and culture building. It's a HR, I'm HR. It sounds HR, but unfortunately you see that that's what's going to be your biggest hurdle in future. Because then money might not come now, but it'll come later in future. And these are the things which is going to cause you problems like getting the right guy on the job, attracting good talent, standing for something. There's a reason why some people go to Tatas and some people go to Reliance. There is a clear reason. But those are things which we don't ask questions because we're usually tempted by the cash in hand or what they show as a comp. Or we have another decision which said that people are very easily, because we're in business now, we're easily able to say, yeah, that is business ethics. And there's a personal ethics which is different. I wish there was no difference between what you thought was good and what your business deserves your best to be.
Thank you, Manoj. So we had a very good consensus at our table, even though most of us came from different backgrounds. I think the root of the problem is, does the fintech sector get into lending? Is there a difference between providing fintech services and actually taking loans on your books, either directly or indirectly? Now, that was a question we asked many of the startups here also. Will it appear on your books? And almost everybody here said, no, it won't come on my books. I personally know a case of Byju's where, for the fees, I'll just digress for 10 seconds. Byju's goes to a carpenter. They sell a course, and the carpenter says, I don't have money. They say, don't worry, you pay, whenever you feel like. And Byju's goes to an NBFC, gets funding from the NBFC for the education course, books revenue on day one, shows a profit, everything is fine, but the carpenter stops paying the EMIs after 2-3 months. And the NBFC is quite happy because the NBFC doesn't know the carpenter. NBFC says, okay, Mr. Byju, your FLDG is there. I'm going to encash it, and I'm quite okay. Okay, so now the loan is sitting in the books of the NBFC, but the NBFC doesn't take risk on it, right? Who's taking the risk on it? Byju's is taking the risk on it. So if the fintech sector does something similar to that, is it a good idea? So once upon a time, these fintech guys, before RBI regulations, they gave 100% FLDG on these buy now, pay later products, and happily they were taking the risk. So there is VC money flowing in through equity, and there is a NPA loss in their books, and it's okay. Startups can make losses for a few decades, or it's all right. They'll change the world maybe after a few centuries. That is the formula in some cases, isn't it? So one fine day, the RBI said, look, Babu, are you a fintech guy or are you an NBFC? Let's be clear as to who are you. So that identification problem happened, and RBI now said, okay, you can provide all these FLDGs only to the extent of 5%. Now, the moment you say only 5% and 95% risk goes to the NBFC, the whole model collapses in 5 seconds or something. And that is exactly what happened in the case of Zest, and I'm sure it is happening with everybody else. All of us at the table felt it's fair. Because for an NBFC, a regulated entity, a bank, there are 100 regulations they have to pass through. There is an NPA regulation, ECL regulation, capital adequacy regulation. There are so many things. And this fintech has, I don't know what capital they have. Most of them will have, accumulated losses which are more than their capital. And unless their next, VC funding comes through, they are living from one fund to the other. Now, that kind of a company to kind of go ahead and lend in the market, directly or indirectly, is a systemic problem. So we all believe that RBI has done the right thing. Going forward, perhaps what should happen is that if the fintech is really that keen on lending, they should form their own NBFC. And there are NBFCs in India today. We work with some of them in my office, where they are powerful enough to set up an NBFC and they are smart enough to set up their fintech wing. So that's the way probably India should go ahead. Otherwise, we are staring at a subprime crisis of Indian origin, which I'm sure that none of us would like to have. So we have more or less consensus on, what should be done going forward. Yeah.
So if I give a fair number on basically how many villages are there in India, there are around 6 lakhs villages. And how many bank branches we have? So we have around 50,000 bank branches. So this shows basically how big the gap is. Okay, so that probably answers my first question, ki what basically most significant barrier is basically the reach. Okay, there is no reach, and that's why there are a lot of players, non-institutional players, which are coming in picture to serve either, I'm not talking about the account, but also the credit. Okay, so that is one big barrier, and that is where the fintechs can play a role probably to bridge that gap between or increasing the underserved population, and particularly when we talk of underserved population, it's basically a deep rural area. When we talk about deep geographies, there is always a language barrier, yes. There is always a lack of awareness, second. So this can be through an awareness campaigns, may it be through fintechs, may it be through the governments, and particularly a language specific thing, assisted journeys through a very specific example here. We have Anganwadi workers. Okay, they are already at lot of places, so why not empower them basically to help not only the one who don't have then, the accounts, but as well as other literacy to particularly the underserved population about what is banking is, the basic things, which is still missing. Reach is the basic thing, and fintechs probably can help in different ways, like providing, as I said, basically providing credit to them, and particularly serving the underserved population. In nutshell, that is what I could say basically.
Super, thank you. We had a pertinent question, are they threat to traditional banks? That was very much unanimous that no, they are not threat because they have to coexist and both of them will grow. So, and one thing is very clear, at least in Indian context, these are not going to be because of the regulation, they are not going to become banks, that's for sure, because at least the prevailing regulations don't give a directional or any kind of a thing that these neo-banks can become banks. So that is one part. Now, the key question of hyper-personalized solutions. See, if you look, the table was clear that in Indian context, having a large geography, while we may use the word hyper-personalized, we have enough of solutions which needs to be addressed, which could be the underserved customer, specific to MSMEs, which we saw. So there are wide varieties of options which these neobanks could address within this geography. So it's not that much amount of, I would say still there are enough amount of larger solutions which needs to be bought that which can be addressed by these neobanks. And largely, I don't know why this question was there, but this is my view. Why are these neobanks going to go global? I think you have enough of problems or solution statements which it requires in India itself. So that's a stepping stone before they go global.
Regulates neobank, but there is a paper by Niti Aayog where they have suggested how you will be able to do this. So they have suggested to RBI that, look, this is the manner in which you create a prototype, you put them under observation, blah, blah, whatever. So there is a very detailed process that they have defined for RBI to start recognizing neobank in a very controlled sort of a way. So it's very interesting to read.
Yeah, but extending to that same thing which I saw, it in a way would give a direction for somebody to say that, look, you will get a banking license. And looking at the prevailing conditions of our regulatory framework, where they're trying to stop banking license, yes. Had that been a clear one, I am sure that enough of people will just jump into neobank because that's the ultimate destination.
Next. economy by 2030 from 2 trillion currently. Agriculture is also going to grow from 400 billion to 600 billion, right? A large increase. At the same point in time, what is happening in agriculture is a lot of technologies coming in, precision farming, even blockchain technology being used in supply chain and market linkages, right? So these changes are happening, and as the earlier group said, we have a large agrarian population, right? 20 crore farmers, almost. Still 1/3 are not being served by formal financial institutions, right? That's a huge number in itself, more than 10 crores, right? What we think is that Fintech have a major role to play, particularly in reach, right? Driving innovative products with banks as well, because traditionally the lending to agriculture has been more of a regulatory push. Now, banks also need to look at as a, core business model, profitable business model, and they need to work with Fintech to make innovative products where everybody benefits, including the farmer. And the other part is bringing data. So Fintechs can bring in a lot more data than traditional banks. That's where we see. Talking about alternate data, it has already started. We see satellite data being used. We see crop transaction data being used. There have been pilots on using data from the mandis to fund the farmers. The ENWS, like a negotiable way of receipt, which has been digitized, and based on just the digital receipt, the farmer or the trader can be funded on the crop stored, right? But yes, when the new data comes in, the challenge is, typically lenders would not like to believe on that data, and then there is a process. How do we, ensure that this data has a real linkage to the portfolio quality, right? So that's a challenge, and it will take time that fintechs will have to work jointly with banks on it. Coming to the regulatory point of it, if you have MSME, the sector has grown. Everybody is focusing on MSME. There is Mudra, there is credit guarantee scheme on MSMEs. But unfortunately, agriculture as a sector lacks a credit guarantee scheme, right? So I think on the regulatory, together everybody needs to work on the credit guarantee scheme. Also for access to data to fintechs by certain government data, which fintechs can access, and we can enable lending that way. And on future, I think it is more of innovative product, use of blockchain, use of e-rupee, digital rupee, wherein innovative products can be delivered by fintech to farmers. That's what the group feels in general.
Thank you. Next topic is probably the most.
Manoj, just one more thing. I just thought, to add to what he just mentioned, is that till the time the banks in this country consider priority sector lending as something which is onerous, extremely arduous, fintechs have a fantastic opportunity in this country to kind of cater to them.
We discussed 2 points. One was, as of now, every fintech is facing actually the KYC challenge. Mr. Naveen, who was part of this. So we suggested at policy level that like Aadhaar is being used for other things, say somewhere something related to KYC can be centralized. So instead of every fintech doing their own KYC, there can be a number, already there is a KYC number, but then it is not being used for that particular purpose. So that can be one initiative to expand the horizon of fintechs, because it would be easy. And then second, we discussed a product where I can say that shop owners or shopkeepers, there can be a product devised for shopkeepers to say take the term insurance by investing in on daily basis in index mutual fund, and if there is a shortfall at annual level for say premium level, that there can be a banking partner for OD part of that thing, so that combining a banking partner for OD, investing into direct mutual funds, and parallelly covering the insurance, because what we in table discuss is that that is a area where shop owners does not want to go for that term insurance area, which is actually required because annually they have to shut down a a specific amount of premium which they do not want to commit, but they would be probably ready to pay for on daily basis. That is one. And then if they will keep that saving, some amount in a saving account, that does not serve purpose, that is consumed, rate of interest is not good. Okay. But then if it is in an index fund, probably the rate of return is more, and then over a period of time, maybe 5 years, 6 years, if they can continue this policy, probably whatever the corpus they will be creating, that return generated from that corpus can take care for the insurance which they otherwise they opt out. That was the two things we discussed.
Litesh and Mohit, both of them, their companies focus on supply chain financing and MSME lending. So we had very interesting discussion here. Obviously, the discussion first started with something which was more like, why do corporates larger corporates get away with defaults while MSME is painted as villain? But Litesh pointed out that actually the NPA in MSME is indeed higher than what you see in larger corporates. So the first question that we spent some time talking about was what are the main challenges in raising this fund or lending. So basically the main thing that we all recognize here is that it's much more difficult for MSMEs, for any lender to really evaluate the risk profile of those MSMEs, because most of the time these companies are very, very focused on business. So the founder there will really know how to run the business, but they're not really so much focused on financing. It's like an afterthought. So books are not even kept. The GST has changed those things, but still far from being perfect. And that makes it much more difficult for any lender to really assess and decide whether they will like to lend money on that. And as a solution, in fact, we thought that, I don't know how will that be done, but better education that how this keeping books in order, etc., can really help you secure more lending, and the money that you might be saving by not paying taxes because you do some certain amount of dealing in cash or not show it on book will be offset by your growth if you can really secure lending. And there are other, I think one of the companies talked about other non-standard way of lending like supply chain financing, invoice financing, etc. That is also helping in that. From the government and financial infrastructure, etc., there was a suggestion, very nice suggestion. In fact, your team also talked about that, the central repository for KYC, because especially for MSMEs, that becomes like a big hurdle that I need to get this done. So if this has been done for one particular purpose, for your opening a bank account, why can't it be used there? As well as central repository for assessment data. Like if I took loan from one place, that data should be accessible. Those parameters are, after all, across all sort of lending. So others also should be able to access that data and make quicker decisions. We also looked at the impact of new technologies like AI, ML, etc., and how it could be used. And our feeling was probably it's too early for that. Right now, the bigger focus is on having better domain knowledge of a particular MSME. Like there is a company, startup that was talking about financing just for the dairy thing. So that is something that will probably help them get better sense of the risk involved in a particular funding and so on. And right now, the data is so dirty that AI, ML, we didn't really feel that it's something that can be very, very helpful. And last question was, in fact, everyone was looking at me saying that how can fintechs lending to MSME get funding more easily? And the general feeling, I mean, I hear from many places that VCs are here or investors are probably not doing the job. But the fact is, it's like a fintech lending to MSME is just like any other startup. So they just need to come up and present the business model that looks workable and so on. So funding will come. Though I have seen couple of at least funds which are impact focused and which are looking at not just climate tech, underserved areas, but also things which are going towards smaller businesses and so on. So the very focused sort of funds probably could play a role.